Well, good afternoon, investors. Mark Robertson here, along with my dear colleague, the magical mathematician of Michigan, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. It's been a really good 24 hours. The meeting that we had last night that I was referring to before this meeting started was a very, very productive meeting, and I walked out of there feeling very pleased that maybe we're going to be able to make some changes and boost our returns a little bit. I see our president is here today at the bull session. Hello, Mary. Glad to have you with us.
Well, you've been having your fair share of good meetings lately, so maybe
Yeah,
we
we
need
have.
maybe we need to have one and talk about that estate plan sometime. Um, just kidding. We're also joined here by Houston's Matt Spielman. Good afternoon, Matt. I know you're in the
Hi,
back room
guys.
and he's lurking. And
Yep.
he probably will jump in. I do want to point out that Matt has shared some interesting information, which we're all kind of scratching our heads over with respect to in mode. Do you want to nutshell it for us, Matt, before we get underway here?
Sure. Well, InMode is down 11% today, which piques my interest and makes my trigger finger itchy. Particularly because they reported earnings already for the year, so it's not an earnings thing. And there's no news in Yahoo Finance, in my brokerages, or anywhere else I could find. I did find a couple of recent, and everyone knows what they are. The law firms put out their notices looking with class action lawsuits looking for shareholders, which is kind of always a dubious prospect for me. But it did lead me to a number of reports from a source I'd never heard of before, the Capital Forum, which I do have links in the stocks area of a item I posted on the InMode. A number of their more recent ones, and the ones that these lawsuits are targeted at, are for subscribers only, and this is not a nominal subscription service, but there are a few older ones because their first report on InMode came December 22, and they're all different sort of things, so that you can peruse them and see what they are. But I was doing some research on the Capital Forum, and they do not seem to be a short seller like Hindenburg or something like that. They do seem to be earnest journalists or analysts, not sell-side analysts. One thing I did look at, I'm looking into some of in their about section. There are a number of corporate situations that they sort of take credit for, and guess one of them from the past was stamps.com, where Stamps got in trouble for reselling their discount postage to, instead of the post office. They sort of take a lot of credit for mucking that, or raking that muck, say it that way. And there are a number of other ones too. So still to be determined, obviously, to see what you want. But if you see what's going on, we can follow it on. I've seen no mention at all, either from the company in press releases along this time, or questions from their analysts on their earnings calls about any of this. So is it ignored? Is it a mouse that's squeaking loudly, no one has heard it, or is it yet the other shoe to drop? Who knows?
Okay, well, we can certainly encourage everybody to keep their eyes open. Please share any concrete information that you get on that. I'm reminded of some of our efforts in the past when the short sellers were attacking um, the medical diagnostics company that we tracked for so long, and it turned out they were complaining about improperly filed expense report by somebody on the custodial staff. Not exactly the CFO heading for Mexico with millions of dollars. Anyhow, the stuff can get pretty entertaining. All right, we're going to do something a little bit different here today. Going to dig into a contribution by Ben Carlson and spend a little bit of time talking about what we do, how we do it, and making that distinction between stock selection and portfolio design and management. So, Ken, anything you'd like to add other than you want your number to be more prominently displayed on your jersey, or?
Nope, let's keep moving, Mark, okay?
All right. All right, here's your weekly reminder that Portillo's is not a sponsor of this session, although they should be. we'll just leave it at that for this week. All right, here's our standard disclaimer. You guys all know this. A lot of very familiar names. Welcome back. If you happen to be new to this, everything that we do here is for an educational purposes only. It's a demonstration. We're big on demonstration at Manifest, and we try to illustrate some principles, methods, techniques, and philosophies, and that's what we're here to do. No investment recommendation is intended whatsoever. Please do your own homework. If we own something that we're discussing, we will try to remember to disclose that. And again, we are of the opinion that you are smart enough. First of all, you're here. You're smart enough to figure out what resources make the most sense for you. We are 2 weeks out from our next roundtable. It actually slides into the first week of March this time around for the February roundtable. So please make a note of that. We'll have a slide later on to remind you. And then in the spirit of reminders, if you'd like to be added to the reminder list and get a reminder email about that monthly webcast known as the roundtable, we'll be talking a little bit more about that in a minute. Send an email to nkabula1@comcast.net. For anything else, my email address and Ken's are at the bottom of that page. Anything else, sir?
No, I think you did a nice job, Mark.
Okay, let's go ahead.
Graph's looking really good today, isn't it?
It is. It's backed up a tiny bit. I don't know how much, but it's backed up enough that we can probably go out and get more ice cream and party hats for another cross of 10,000 on the value line arithmetic average. But again, this is just something we display on a continuous basis because we think it's a fairly straightforward way to think about the stock market. Anytime those green bars, which represent the stock market, as represented by the value line arithmetic average of the 1,700 stocks, as the notes say, anytime it's below the blue line, it's probably a decent time to get out there and shop in earnest. Anytime they get substantially above, maybe you slow down a little bit, maybe get a little bit more selective, but in general, invest regularly, where that's what we're going to talk about. And you can see that the average return forecast is in that 10% neighborhood. So it's a good time to go shopping.
I think it's real interesting, Mark, that the two very different databases, the Value Line database and the Manifest Investing database, are both signaling 9.7% as an average return going forward. They stay close to each other, but that doesn't happen that they're right on top of each other very often.
No, there's always a little bit of a difference. Again, you're talking about different coverage universes, and just for example, that 45% number does not include dividends. So
yep.
9.7. So keep that in mind. So I do find it interesting that Goldman Sachs has already changed their forecast for the year for the second time this year, which is really interesting to me. It's kind of like changing the speed limit signs to match the speeds you're going. Never mind. I'm going to get in all kinds of trouble. We'll stay away from that topic. All right.
Next slide. There we go.
Here's our sound bite for the week. And the reason that I chose this one, and Ken, feel free to expound, is I keep reading these headlines about how the world is ending because certain companies are laying people off. And I'm not making light of when that happens to any individual. But again, I would just encourage everybody to keep it in context, keep it in perspective, because the layoffs this year are much smaller than they've been, not only for last year, but even the year preceding that. And Ken, you wanted to make the point that some of these are not necessarily so permanent.
Yeah, Mark, I asked Mark the question before we started whether a layoff was the same thing as a dismissal, and he was quite clear that they're not, that a lot of the layoffs are indeed temporary. So we don't have any data as to how many of these people are back working for the same company, 3 months in the future, 6 months in the future, or whatever. I just think that filling the hours of business news that has to be filled, whether it's Fox or Bloomberg or CNBC or whatever it happens to be, is such a task that that a lot of our people that are speaking on these channels, and it doesn't necessarily have to be even on television, are saying things that they wish that 20 minutes later they could pull back and restate. I think you're right, though. However, we get an awful lot of the sky is falling kind of news. And sorting through that is an extremely difficult thing for the average listener to do. I think that's why there's a lot of people in maybe more mature folks, maybe in their post 40 era, that kind of leave news alone anymore. They kind of don't listen to a lot of it anymore. It goes over their head because sorting out what we're to actually focus on has become very, very difficult in a world where all you have to do is say, I agree I agree to disagree with you, whether it's fact or fiction or whatever it happens to be. It makes it really hard.
And the other thing that you have to be careful about with, I would say almost comprehensively with the news media these days is, they would take this point here and, write a headline that layoffs in February are 20% greater than they were in December. And that's factually true. But, you start comparing February 2024 to this number, again, keeping in the context of the longer term situation, you can spew facts that are just not really facts when it comes down to it, or certainly not the type of actionable facts that we like to deal with. So anyhow, that's just the rant or the vent for the month or the week. All right, back to the Groundhog Challenge. We are starting to settle in now that we've been at this for a few weeks now, and we do have a new king of the hill at the top. Keith Tubbs checks in at 13.9%. The average groundhog is currently at 2.4, down a little bit from last week, but we still have, call it 60% of us topping the market performance. And there's a number of clubs on here. Those are bolded in. And we note that Kathy Wood remains near the top of the list. And there's quite a few new names. And we're most distressed that Ken and Mark are missing from this list. Hopefully that's a temporary condition. But some really good, nice new names on there. There's a few perennials on here. But just good to see the clubs. And we're off and running. We do like to point out that one of our knights is holding down the fort at number 37. And we have returned to the value line arithmetic average, topping the Wilshire by a few percentage points up here in the box. Any other thoughts, Ken?
No, but there were certainly some huge jumps. We should take into account this is as of 10 days of trading, so we have a couple more days to go in the contest yet. But I think that these huge jumps indicate how unsettled the market is at the moment, and things are moving around an awful lot. If you're holding NVIDIA, it's backed up 3 or 4 or 5% today, and they're saying it's in anticipation of earnings. Heck, I don't think earnings, anybody knows what they're going to be, but if they're anticipating something, I don't quite get why it's backing up. It doesn't make sense to me. Does it make sense to you, Mark?
I don't know. I asked the question of Sean Mason. He said, they're concerned about all the congressional representatives selling their stocks or something. I don't know. So who knows? So we'll leave that one alone too, because I don't need the CIA or Homeland Security paying any more attention to it than is necessary. The monkey is annoying and back on the leaderboard. He's been missing for over a year, and he's still out there. All right. So with that, let's go ahead and get into a topic. This one just kind of triggered many things for me. It's written by a gentleman by the name of Ben Carlson. I have the utmost respect for Ben. Ben is a great guy. He's a member of the Ritholtz team with Josh Brown. And I've actually spent some time with Ben. He operates out of Michigan, so that makes him extra special. And he had written this article talking about stock picking and just investing kind of in general. I thought it might be interesting just to kind of walk through it. And again, utmost respect for him, not picking on him. In fact, this should be taken in the spirit of I'm just asking some questions. Ken and I just want to air some of this stuff out. And did you get a chance to take a look at the whole article, Ken? Any
I
thoughts
read
from
I
35,000?
read quite a bit of it, and I tend to agree with a lot of what he's saying. The only thing that he doesn't say is that when you get bit by the stock picking bug, sometimes you just can't. It's awful hard to switch gears in the middle of a portfolio. Does that mix enough metaphors for you, Mark? I don't know.
Yeah, I agree with that. Although we do have some colleagues that have kind of made the jump to exchange traded funds or mutual funds, but in general, it can be addictive. It can be quite rewarding, and that's part of the case that we like to try to make. That whether you're in a club or operating independently, the process of learning to identify excellent companies and own them for as long as it makes sense to do so can be uh, quite incrementally rewarding. And that's kind of been our experience. And I like what he says down here. You know, he understands that, you know, index funds are for those that don't want to do this in a sort of a hobby fashion. I get that. Or within a 401k, as he talks about in that introductory paragraph. And that's good advice. I mean, we max out Wendy's 401k for sure. And basically, it can make sense in a follow-on account like he's talking about here. And he says he will tolerate us if we'd like to scratch an itch. So I guess we could celebrate that. No, but tip of the hat to Ben, and let's kind of take a look. What you're looking at here is the kind of the teaser that he used on Twitter, basically displaying uh, basically a complaint. And this is one that just we were talking about this before the session with Ken and Matt. Um, this is just hard to relate to for me. It's something we hear an awful lot about. You're basically looking at a listing of failure. The way to think of the numbers on the chart, these are the ones who fail to beat a benchmark. So fail to meet their high water mark. And you can see that the numbers ranging all the way out to the far right are in the 90s. And I just focused down kind of down the middle, 5 or 10 year type performance, because we know that's long enough to establish something meaningful. And it, I actually have trouble reading the chart because I actually think the opposite of this. Does that make sense, Ken? I mean,
Well,
I'd rather see a listing of success. And we're going to
and
go into
that's in fact what I read the chart as when I first looked at the slide, Mark. I thought, well, that goes against everything I know about funds. 90% of them doing better than the market. And then I read it more carefully, and in fact, it's negatively stated. So you have to be very careful. I think that 3 to 5 year line is extremely uh, cogent, revealing, whatever you want to call it, because that's where our clubs kind of aim their performance at. And I would stack up a list of random clubs throughout the country, and I really do think we could find more than 11% of them that beat the market, whether we measure it by the S&P 500 or the Wilshire 5000. I think we could find more than 11%, and that would mean that they were doing better than the all domestic funds line, which is the top line on the chart right there. I mean, 1 out of 10 clubs beating the market, I don't think is a very high bar to set for the clubs that I'm involved with, at least.
I'll tell you, I'm aware of many in this area that beat that number, handily. They would be, again, I'm thinking numbers like 40 to 60% beating the market.
Well,
And
and And as a club, Mark, we have certain advantages. Advantage number one is we don't worry about moving the price of a stock when we go out to buy something. And some of these funds are large enough to actually move the price when they make it known that that they are buying something. Witness Mr. Buffett in Berkshire Hathaway. When he makes a buy, he's allowed to shield what he's buying so that the market doesn't know what he's doing. And we also probably don't try to invest in 100 or 150 stocks. Like I would guess that's the size that a lot of these funds are. They're certainly not in the 16 plus or minus 4 range for the most part.
Oh no.
So we have certain advantages, but with those advantages comes some disadvantages. One clunker out of 16 stocks can really drag a portfolio from the top to the middle or lower. So again, I say that I think we could find 1 out of every 10 clubs to beat the market, and that would put it right up there with the entire mutual fund universe.
Yeah, and I'm pretty confident that we would actually top that number based on.
Oh, I agree.
My
100% agree.
My exposure over the years, anyhow. The 3 green arrows are just simply making the point that they fall in that 10-year column, and they land. These are the most successful. They land in the mid cap and small cap growth categories. So that's a hint. That's foreshadowing, Ken. All right, now on the right, this is kind of. We've talked about this a number of times over the last several years. What to focus on when your child brings home a report card, and everybody goes to the F. At least 77% in the study, this McKinsey study that was done by Marcus Buckingham. And when it comes to the realm of investing, when you basically find an area that's challenging or whatever, you want to bring the elements of success. What have the key success factors been, and how do we leverage them to better understand and access opportunity in an area? So I think that's true with the report card, and it's just a good reminder. Focus on the positive, focus on the strengths, and basically bring the weaknesses to their knees where possible. So, any other thoughts on that, sir?
No, I think it's a useful slide to maybe put in the small number of slides that have some real gravitas attached to them. We've come up over the last 18 months with 3 or 4 slides that really say an awful lot with just the graphic, and this graphic says an awful lot about what's happening in a lot of funds, a lot of investing.
Absolutely. All right. So let's talk about some funds that we can measure and see what we can learn from. This is a list that we put out very basically weekly or monthly at Manifest, and it happens to be the top 40 funds measured by performance. So go ahead and think of it as a report card. And you'll notice I'm not starting at the F end, I'm starting at the A plus end. And so this is a list of, we cover about 650 funds in this way within the Manifest database. And you're basically looking at the top 40 of those 600 plus funds. And I want you to notice how very few are above that magic number of 5% that we talk about an awful lot as our objective, but there are a few. And there's another 100 or so that actually have green ink, not red ink. Okay, so you're looking at, go ahead, Ken.
Well, I do notice new names on our attendee list today, Mark, and I just want to point out that Mark is not pointing to a total return column. He's pointing to a relative return column. That means how much you beat the market by. Notice that the total return column is not at the end where you sometimes find it, but it's the 3rd column in on this particular chart. And those are pretty hefty returns. I would be very happy over the long run to make any of those returns. In fact, any of those returns on the entire list, except for maybe that 7.5 down there. but the relative return is how much you've beat the market by. And you can see the arithmetic going on. There's the benchmark. Take the annualized, subtract the benchmark, and you get the relative.
Yeah, so we're basically looking at, and rather than talk about the 80% that don't beat the market, we like to focus on the 20% that do. And again, this is just the top 40. But the thing that we have talked about in the past, and again, this continues to underscore it, is this notion of growth is important. It matters. As you look down that column, you know that we manage our portfolios in general. Most investment club portfolios in that 12 to 14% range. And notice how many of those qualify. So the average growth forecast of the one shown here is this 13.7. All right. When you look at the total stock market as measured by the Dow 30 stocks, now in the Dow 30 stocks, you're going to have large companies and you're going to have a fairly wide distribution across sectors and industries. And you can see that again just gives us context. 7% pretty much across the board for those larger companies. And some of those are in very cyclical industries, et cetera. But then here's the kind of the takeaway. When you take a look at this list of 600 plus professional funds, you see this number right here. And it's partial, it's not scientific, but of the ones that we cover and actually generate this number for, you're talking about a 6% top line growth characteristic, and that can't be ignored. It's the reason that we continuously chant you got to have those small and medium-sized companies in your portfolios to basically stack things up for success. And David L. Babson is there for a reason. He's regarded as one of the fathers of growth investing, and he used to talk about growth companies, 1940s Abbott Labs. He talked about the growth companies as being more forgiving or more self-correcting if you do happen to buy them at the wrong price. Over time, growth heals all wounds, was kind of his opinion. And I think this chart goes a long ways towards saying that. So again, I don't know if we could probably get too wrapped up in the numbers. I do know that from studying investment clubs and looking at their long-term relative performance, that anytime you had a club that was basically, too heavily embedded in the larger companies, you were basically set up to perhaps come up a little bit short. So is that enough preaching, Ken?
I think so. Mark, I'm wondering if this data begins to make a case for altering one of the numbers that Mr. Nicholson wrote about in the 40s and 50s. He talks about beating the market by 5 points. He talks about a 15% average return for the whole portfolio over long periods of time. And he makes the statement in a couple different places that he thinks 11.5 to 12.5% growth, sales growth, should be enough to make that happen by the time you add dividends and then add PE expansion to the mix as well. I'm wondering, in this era of reduced dividends, whether the sales growth has to be a little bit heftier for us to achieve that beating the market by 5 points concept. I'm noticing your average here of 13.7, and I'm wondering if maybe 11.5 to 12.5 isn't quite robust enough to make our goal happen. What do you think?
It's a good point. We've definitely, at least unofficially, leaned that way in a number of areas, like with Tin Cup or some of the roundtable portfolio reviews that we do. So yeah, it makes sense. And when you look at, in fact, we'll put up a slide next week that looks at an 8-decade perspective on this. Dividends are not what they used to be. And
yeah, but I mean, today when we see a 2.5% dividend, we think that's pretty healthy. But I know when I began investing that a 2.5% dividend was not what I would consider a big dividend coming from a company.
Oh no, you go back to the 50s and 40s. 4 to 6 was average.
Yeah.
for a company. So yeah, that's a good point. So okay, so continuing on with some of Ben's commentary. I mean, he's had fun. He's put more money into his play account, if you want to call it that. But he's just confessing that he has a little bit of heartburn over stock picking, and he admits that stock picking is not the same thing as portfolio management. We'll talk a little bit more about that. And again, just makes the point that you can slide back into investing in index funds and that kind of stuff, dollar cost averaging. We all are familiar with that expression. And he begins asking a bunch of questions, which we'll dig into a little bit deeper. But I guess, and again, these would be my responses. First of all, it is fun. It can be quite a rewarding hobby type experience. Second of all, we agree. Stock selection is not portfolio design and management. In fact, we have talked about case studies, not going to name names, but we can actually identify some individuals, professionals, that are extremely good at identifying opportunities. But when you look at the long-term performance of their portfolios, it's just a cascade of failures. So they're not the same thing. In fact, you can look at Value Line itself. Value Line has a mutual fund that has not been that successful. But if you look at the individual stocks, it has been a pretty good navigational device. Any thoughts on that, Ken?
Well, the sentence that I like the best on this whole slide, Mark, is the second from the bottom in the boxed in comments that you've made. And that's that investing regularly should not be confused with dollar cost averaging. That they're two completely different things. Investing regularly just means exactly what the two words say. But it's not necessarily putting in money on a repeat basis into the same stock, sometimes buying more shares of that stock and sometimes buying fewer shares of that stock. That's what dollar cost averaging is.
Yeah, and the argument is when prices go up, you buy less units or shares, and it's basically somewhat of a mindless activity. What we do is far from that, and it's just simply the case. And I think some of the things that we define actually remove a lot of the mystery from this situation. We'll go into that. And the other thing that I think a person who's not been fully exposed to what we do or sunk their teeth into what we do, you begin to learn that your stocks and your portfolios will tell you what to do. And again, some of the evidence is up there at the top. Again, the companies that are mentioned here, first of all, this is a bit of a special edition. These are all 10-year numbers. I know you guys are all used to us having that longer term perspective, but these are all 10-year numbers. The 7 companies listed are the 7 most widely followed by Manifest subscribers. So yes, we went through kind of a rough patch with Cognizant. I blame the recurring and persistent global recessions for what's happening with that company and a few others in that area. But look at the 5 companies up here at the top. We consider the Investing Roundtable to be a living, breathing demonstration of what is possible. And you can see that the numbers are actually getting pretty robust again. We're up to actually plus 5.8% relative return. As Ken pointed out, that's a 17.5% annualized total return over that 10-year period. And again, the numbers at the bottom tell you what an index investor is basically settling for. Anything from 7 to 11% down at the bottom, with one notable exception, and the professionals talk about this one a lot. Nobody's keeping up with this one, according to them. That's the NASDAQ 100. So again, this comes back to the number. Again, we perpetually admit the groundhog contest is a game, and it's not, meant to be any hardcore demonstration. But the fact is that nearly 40% of the people who are playing along, in some cases for all of the 17 years, 37, almost 40%, are beating the market. I think we calculated that the average number of years of participation is approaching 9. So it's clearly getting to be kind of an interesting sample and a lot of fun. Any other
Did you
thoughts
used
here?
to did you used to sit in general science class, Mark, and listen to the teacher talk about a tree falling in the forest but nobody can hear it? Is there really sound being generated?
I'm,
I'm wondering
I'm afraid
if
where
our
you're going here.
portfolios, well, I'm wondering if our portfolios tell us what to do. If they're shouting at us but nobody's listening, then what does that mean? You know, the portfolio might be shouting at us, but I think that a lot of our adherents need to understand what the portfolio is shouting and needs to listen to the portfolio and then respond to the needs of the portfolio. Too often, even after having said it 1,000 times at 1,000 different meetings, that you should never fall in love with a particular stock. Too often we visit clubs where they've fallen in love with 3 or 4 or half the stocks that they own. And when that happens, then the portfolio can shout all it wants to, but it's not going to perform at the level we want it to perform at.
I love where you went with that. I thought you were going to pick on me. No, I mean
No,
I
no.
can think of specific club visits that we have made where I would just say gently, they weren't listening as well as they could have been to what the portfolio was whispering to them. In some cases, standing on the hood of the car shouting. And yeah, they will do that if you learn how to recognize that and listen for it, no doubt. So thanks for that, Ken.
Nick wants to know if I'm an existentialist. He says that exercise is an existential exercise.
He's
So.
right. All right. Just to make the point that again, 5% is worth a lot. 10,000 invested in the S&P 500, which has done extremely well for the last 10 years at 12.5% is worth 38,382. Again, that living, breathing demonstration, because you can look at every single transaction. 10,000 invested in the round table is now worth 50,162. Again, 5% causes this, and an incremental 5% causes that, and that's also a pretty powerful slide when you think about it. A lot of power. Okay, I couldn't resist this one just for a quick check-in on our auto pay demonstration, our janky utility reserve portfolio. And again, I want to argue gently with Ben that I think that what we do does actually interface quite well. And in this case, we built this portfolio, that's the dashboard up at the top, collection of utility stocks that was designed to put off a cash flow stream sufficient to pay all of the utility bills. And we've been doing this now for a few years. We picked 5 utilities. One of them actually got bought out. And we basically used this as the control tower, the dashboard up at the top. Then down here, this is the checkbook. And what we're basically attempting to do is keep these numbers here black instead of red. And I think what you can see here, the ones at the top here, these are actual transactions. Think of the ones down here at the bottom as budget. You can see that we're getting ready to pay the tax bill and continue to pay all of the monthly utility bills. So I think it's a pretty short jump to marrying what we do with financial planning. And I just think this demonstration continues to be, for lack of a better word, cool. Your thoughts, sir?
I love this demonstration, Mark. I think it's unique in almost anything that I see people do in practical investing, and at the same time, it's fairly easy to understand once you get the idea of the profit and loss sheet, going down the sheet and reading it, and the fact that it's working should be eye-opening to a lot of folks.
Yep. So the dividends come in, the check goes out. It's on auto pay. We don't actually write checks. The money just gets transferred to the utility from the bank account, and you can see that we're currently sitting on about $900 going into tax season. After tax season, it'll drop down to a little under 200, but it'll be fine. It'll stay there unless something very unusual happens, and we'll certainly deal with that if that happens. So again, just a case in point of real life economics. All right, so stepping back to these.
And Mark, one question on that. What was the original cash distribution? Was it 45,000 or was it 40,000? What was the original cash distribution?
We put approximately $9,000 into each of the 5 companies, and we had
about 45. So
45.
It's grown a little tiny bit as well. Okay.
Yeah, and that's with some of those being down a bit.
Yep.
Yep. So we have more than we originally invested, and we've paid the utility bills for the better part of 3.5 years. So
okay,
that's the way to think about it. All right, so back to these 40 performers, the ones with A report cards, and see if we can't dig in a little bit deeper. And so we're focusing in on the 20% of funds that have beaten the stock market, just the top 40 of them. And I just wanted to spend a moment. The more I play with this, Ken, the more it kind of sings to me. This notion of this core score, which again we kind of did on the back of a napkin one day. What it basically is taking the quality ranking for any company, and because of the fact that the financial strength and the EPS stability are already in there, you're basically just doing kind of a emphasis added onto the quality score to get this core score. All we do to form the core score is take the financial strength, which again, the merits of this are pretty intuitive. You want a company with strong balance sheets, strong operating fundamentals. That's reflected in the financial strength. And then up, straight, and parallel, we love straight lines during our stock studies. That's the second component. Quality takes both of those and then incorporates the comparison of a company's growth versus its peers and competitors and its profitability versus its peers and competitors. We add these 3 together. So just simply adding these 3 numbers together to get this core score is what we're doing. And I just wanted to see, what does this look like for those top 40 companies or top 40 funds, I should say. And the average checks in right around 240. And then if you take a look at, go ahead.
The maximum number, Mark, could be 100 plus 100 plus 100. The maximum can be 300 then, right?
Yep, just like a bowling score.
Okay. So is this pointing out that maybe when Nicholson said, we prefer that you focus on the model, the up, straight, and parallel model when you're investing. We prefer that you buy consistent growers, especially very consistent growers with a lot of history. But it's okay to fool around a little bit. I'm not noticing any real dismal core scores until I get down to number 34 again, and it's that same exceptional Spear Alpha, whatever that is. I'm just wondering if we just came up with some really good data that just once again proves that the instincts that George Nicholson had about if you want to fool around, but kind of stick to maybe 20-25% of your portfolio. Don't do the whole thing. Maybe we have more data just to indicate how bright that man really was and how prescient he really was in coming up with rules that we could follow and still make a lot of sense.
I think you're spot on. I think it's part of the question we're going to try to answer here in a few minutes. I mean, these guys are brand new. They're basically an embryonic Cathie Wood fund is what these guys are. And they're being reasonably successful so far, but you can see the type of companies they're investing in would be regarded by us as pretty much non-core, or in the vernacular of Wall Street, special situations. This one
Carol
up here
has her hand in the air, Mark. I'm going to unmute Carol for just a second and see if she has a question. Carol, go ahead. You're unmuted. Carol Dallel. Carol, was that an inadvertent hand? Okay, I'm going to take the hand down then and continue. Mark, go on.
Okay, so again, we're talking about searching for these with strength. The other exception here on here, Ken, by the way, Barron Partners Retail. I believe that fund is about 80% Tesla. So that accounts for some of the lower overall rating, and it's not necessarily representative of how we would generally approach investing, so that it gets a little bit lower score. But what I found when I looked at, well, what the 100 weakest funds actually operate down here, so you're basically talking about, average characteristics around 80 versus average characteristics around 60. And I just think what you said earlier is perfect. It's basically telling you, it's giving you the license to do a little bit of special situations. Just don't get carried away. All right.
Nick is asking, Mark, if what you're doing has the ability to mask a very score. And he gives the example of, what if you had a financial strength of 90 and a quality of 90, and an EPS stability could then be masked, because you could still have a decent core score with a really low EPS stability. I'm gonna take a stab at part of the answer. Nick, EPS stability is part of the quality number as well, and a low EPS stability number, I think, might very well preclude a 90 quality rating. Mark, am I close to anything?
Yeah, I mean, you basically can have that situation, especially with a smaller company. Let's take the financial strength as an example. Just launching off of that same thought, you can find a fairly new, young, promising company that has a financial strength rating of B or B plus, and with the propensity to potentially go, higher. So that's dragging the score down. But at the same time, that exciting, promising, smaller company has an outsized growth rate. So it offsets that lack of financial strength in that embryonic company, and it does compensate. So I think that's kind of what Nick is getting at. There is compensation that goes on here, and you always have to be mindful of that also, and not be absolute, I guess would be the way to think of it.
And we've been very clear in presentations when we're talking about this core non-core that there is a line that we will draw, but we see a fairly decent gray no man's land on either side of that line, where companies can go in either direction when it's close to whatever that number is that we set as the difference between core and non-core. Have we actually decided on it, where the line is? Is it 220 or something like that, Mark?
I'm starting to lean more towards 240, but no, we haven't.
Okay.
Look at that number.
But wherever we finally draw the line, we know that it's not an exact line, and that there's a fair amount of squishiness on the top, right above that line and right below that line.
Without a doubt. Okay, so back to Ben, and Ben is basically making a very honest admission here, that, and this is true for many of us, that selling a stock is the toughest part. And in fact, it's probably the part that destroys some of those extremely successful discovery people we talked about a few minutes ago, because they can find the excellent ones to discover, but they just don't know what to do with them. And that's true for many of us. I mean, I've had a number of situations, learned a lot over the years, and I do think that our selling disciplines help us with the answers to some of these fairly troubling questions, because I know many of us have had these thoughts. Peter Lynch talked about watering your weeds and cutting your good flowers and all that kind of stuff. And what do you do with the money when you take it out, and all the things that you have to think of. And there are some real behavioral hurdles in the question. And here's our summary on the right. And first of all, you look at the overall portfolio and listen to it. Do you have enough quality? Do you have enough return forecast? And again, Nicholson suggested that taking care of the portfolio should account for as much as 90% of these decisions. We think it's a standard best practice to take the one with the lowest or weakest return forecast and ask the question, can I do better with my personal portfolio, or can the club perhaps be better positioned by switching that one out and then replacing it with something else, which will make the portfolio stronger. So I think that is the number one reason for selling, probably the most powerful discipline. Any thoughts on that, Ken?
I agree with that, Mark, and I also agree with the second one, that if the core holdings are down around, money market. What's money market today? 3, 4, 5%? I'm not sure. But if they're down around money market or below, you should at least consider maybe snipping it back a little bit. But I also remember the guidance that says be very, very careful in getting rid of stocks that have a high rate of top line growth. That's sales growth. When those sales growth numbers turn double digit, sometimes it's the data running to catch up to where the sales are.
Exactly.
And when that happens, you can't always trust your numbers to be as accurate as where they might be in 3 months or 6 months. When I see 15 or 20% sales growth, sometimes I know that the analysts haven't caught up to where the company is moving to.
Yeah, and in fact, I'm reminded of the words we expressed earlier from David L. Babson, that growth heals all wounds. And I'm also reminded that all of us, and when I say us, I mean our larger community, the Morningstar analysts, the Value Line analysts, we all have a terrible challenge of putting PE ratios on the younger companies. It's one of the biggest challenges with early stage growth. So just something to keep in mind. For non-core companies, again, you should expect more. You should be willing to sell them at a higher return forecast, maybe something down around market average. Again, this isn't automatic either. Now, if that all sounds like mushy mealy stuff, it is, but everything should be case dependent. Third item there, and this is something we're going to be doing a little bit more work on, probably between now and the National Convention, Ken. Hint, hint, nudge, nudge. Hey, if the quality's falling apart,
I'll add it to the list, Mark. Okay.
if the quality's falling apart, this is not an emotional exercise. It's mathematical, and that means that the financial strength or any of the relevant quality comparisons are degrading or deteriorating, and it's something that should be monitored. And those last 2 bullet points, these are also, if you have a situation where you're looking for an opportunity to sell a company, these are some of the conditions which you might want to watch for. Yes, a portfolio position can get too large, and you should be looking
Mark,
for opportunity.
we have a question. What's MFI, Mark?
MFI, I'm sorry, that's money flow index. It's the relative strength index, only corrected to account for volume. Len Douglas has done some outstanding work on the forum on this. And MFI, we'll talk about this more at a future bull session, but the relative strength index overbought at 70. The mutual or the money flow index is overbought at greater than 80. And it's kind of interesting to look at the two side by side. All right. So I would just encourage all of us, including Ben, to realize that there can be some fairly decent disciplines that we follow. We follow these, by the way, in the model portfolios that we are affiliated with. Okay. All right. So it's easier to ignore. That's probably true. Those type of funds. It's harder to ignore individual stocks. I would somewhat agree with that. The market can go crazy. And he cites the case of Lyft moving 30% in a few days, fairly recently. And there's a couple other stocks. Well, every morning you wake up to one that's down much larger, and this happens all the time. That's true. But it's not a reason to be afraid. And again, I'm just going to take a tiny bit of issue. I don't think we should ignore anything. We should try to remain aware. And in the case of Snap, I would just say you can't ignore this. And once you understand what those three numbers add up to, you can't be surprised by anything that happens. So that may have been a little bit strong, but I
It's
think
not a park we play in, Mark. It's just not a place where most of us invest.
and
You
if
know, and if you are investing in that park, you're going to get mugged a lot more often than you are in other parks.
I'm not sure I would use the word invest, it's something else. That doesn't mean that it's not potentially rewarding under the right circumstances, but the last thing we should be surprised is by price volatility for a company that has that core score. Um, that's all I'm going to say. And then the other thing is just, and again, I'm not going to go too deep into this. We talk about this a lot. A lot of the financial services industry is basically geared and engineered and designed to deal with these red or orange areas down here. We talked about this at length a few weeks ago, and it's obsessive. And again, this is coming back to the report card theme, at least for me, of why focus on the F's when you can focus on the A's and the B's. That's the blue areas up there. Um, Focus on the strengths and stop worrying so much about what an occasional diversion or weakness will do, because it's just not worth it. And it's certainly nothing to be frightened of. So, should I dismount from my soapbox now, Ken?
You can do a double half gainer flip, okay? Whatever you need to do.
Oh, it just drives me crazy because what they charge to do that, and fear is it works. It just simply works. That's I mean, I heard a story last week about a newspaper in Europe that did the experiment of only uh, printing positive news, and they went out of business in a couple months because people will read the other stuff 9 times more likely. Not that we like it, but anyhow. And here's the other reality that again, focusing on those tiny little glitches. This is reality. The 2008 situation back here, that was the worst thing to happen since the Great Depression. And you can barely see it on this chart. And so I'm serious. Show me where the market hurt you, because back in that time frame, if you were fortunate enough to continue to invest regularly, you're smiling. Same thing happened during COVID. If you continued to invest regularly, wonderful things happened. So again, without belaboring the point, turn off the TV and go shopping for excellent companies. So let's close with this. And again, this is that age-old question. Ken and I get this one every once in a while when we're on the road. What about all these professionals with all their degrees and letters after their names? And if 98% of them fail, obviously it's too challenging for us to go out there and do it. It's quote unquote hard, and portfolio management makes it even harder. I don't think so. Not if you do some of the stuff that we talk about. What makes it different? First of all, the landscape's different. Ken already mentioned that earlier. And the difference between the long-term perspective and having to try to figure out what's going to happen for the next 30 or 90 days is massive. The rhino time horizons are different. One of the biggest mistakes I believe that they make, and sometimes it's by necessity because they can't invest in the smaller companies, but smaller companies are not the same as small cap. And then Ken actually reminded us about Eddie last week, so I'll let you take the next one, Ken.
Well, Eddie Elfenbein has a remarkable record of choosing winners. His portfolios aren't necessarily magnificent. They don't necessarily outpace everybody's, but the stocks within those portfolios, he had a success rate of, and I'm going to quote a number, Mark, and I hope it's close, was a success rate up around 75, 80%, if I'm remembering correctly.
Oh, yeah. Beating the market 13 or 14 of the last 16 years.
Okay.
16 years.
And and doing it by choosing stocks that many of us are intimately associated with. We know them upside downside. They're good, solid, medium-sized companies, and they don't try to be anything that they can't live up to, and yet they pull the portfolio and they do all the heavy lifting that we need them to do to make the portfolio ultimately successful. He's an exception to the rule of a lot of these guys that are doing stock picking right now. And he gives you a set of stocks, and then he says, now sit on them for the next year and see how they do. And if you have the patience to sit on them, you're looking at a pretty darn good list most of the time.
Good stuff. And again, a lot of the stuff that goes on with CNBC and the 24/7 news cycle, the shiny object in the room just drives them crazy. The Magnificent Seven is just driving them crazy over the last year or so. We would simply take a step back, take a look at the long-term perspective, and put out the par and quality ratings for the seven and yawn and say, okay, one or two of them's on sale, go for it. Yeah, the shiny object just completely makes it difficult. So again, it boils down to this notion of the quality matters. The core characteristics generally behave better, and it keeps us safe. Growth matters. And when we say, one of the things that the questions that I run into, Ken, that is always attacking forecasting and, mathematical definitions of failure of forecasting and all that kind of stuff. And I really think of what we do. Yeah, there's forecasting involved, but it really is this notion of expecting or imagining, what is possible, especially when you're dealing at the strength end of the report card first towards excellent returns. So, again, I think that it's as easy to sleep at night, and I would argue even better, sleep better, using some of the stuff that we do. Any other thoughts, Ken?
Well, the one thing that our community has done really well, whether it's manifest investing or better investing or our clubs, is they've taught the people that have listened, they've taught them how to identify high quality stocks. I can't remember ever finding a better investing or manifest investing portfolio that was not made up of of an average that gave me a high quality rating, somewhere in the 85th to 100th percentile. And I think once you identify that high quality portfolio, your job's half done. You just have to listen to what else the portfolio is going to say. And you have to remind yourself that even high quality stocks get overvalued sometimes, and it's okay to get rid of them. And if you like them 2 years later when they're not overvalued, it's okay to buy them back again.
Absolutely. So again, coming back to George Nicholson, God bless him, gave us a short laundry list of what's important. And then I would just come back to, they've got all these people and a lot of extremely gifted, intelligent people running around out there. And the question I would pose is, well, how's that working out for you? And just leave it at that. All right. We won't do any more action on the portfolio. This is that a real money portfolio we've been putting together here during bull sessions. We will get another infusion between now and the next meeting, so we might do something next meeting or the meeting after that to make some additions. But it's beginning to build out pretty nicely. And Ken, I think in terms of a report card, we're in a nice place here. I think we want to stay there based on what we've been talking about here this afternoon.
Mark, do we have a general breakdown of, not including the Vanguard growth, but a general breakdown of where we are on size of the companies with any kind of pie chart yet?
We do. I mean, you can go to this link and actually check it. The mutual fund in there kind of messes it up.
It's going to include the growth portfolio, though. Okay.
I think we're
all right.
okay.
So what I need to do is put a portfolio in that doesn't include Vanguard growth and just take a look at how we've done so far. Yeah.
Yep. I think we're probably in pretty good shape, but as we wean ourselves off of the Vanguard fund and build out this portfolio, we want to make sure that we have a sufficient number of smaller and faster growing and medium-sized companies in the portfolio. Everything else here is pretty much copacetic. I am going to be keeping a bigger eye on the core score of our portfolio. It looks to me like that's 180, 250. We're right there, Ken. 255. We want to keep that
Okay.
number
Yeah.
in the range. And again, that gives us the flexibility to have some of this. This is an exciting company that we talked about a few weeks ago. A little bit less predictable situation. All right, so we will be back to that in the next week or so. Here's your reminder that we do archive all of these sessions on YouTube, whether they're bull sessions or those roundtables you've heard mentioned. And again, the next roundtable will be on March 5th, as is shown here. We will be taking a look back at our selections made over the last 12 to 18 months. Ken, you're still in the number one seat.
Oh, what are you doing? Trying to jinx me as much as you can,
I
right? You know?
I am. I might do a full-blown study on that one and praise you up and down to see if we can't take the edge off between now and March 5th. No, yeah, I think you're safe. What's not to like? All right, and here's our rhino tribute. For those of you that are wondering what I'm talking about with rhinos, go to Manifest and look up rhinos. And while we affectionately think of the Wall Street institutions and analysts as rhinos, and this is a shot taken from just the other day at the Detroit Zoo with my grandson Logie, and he's been running around ever since this point in time talking about rhino butts. So this is his favorite slide for this entire deck. So, and he's
All
4.
right.
He's
All right.
4 years old. All right, just some other stuff here, and this is the discussion of Neogen, which we're going to defer for a couple of weeks. This is just the tease. We'll actually cover this a couple weeks out. I want to do one of our very long-term looks. I see she's in the audience, kind of inspired by the work done by Diane Grace several years ago on Dana Corp. I'm going to do a similar situation talking about what it's been like to hold Neogen for a very long time and what we see with the company in the current situation. So we'll come back to that in a couple weeks because Ken's going to be traveling next week. And Neogen's kind of one of your babies.
Still on it.
All right. Anything else in the hopper?
Nope. This has been a fun one, Mark. And again, I just want to thank our audience for showing up. Without you, we'd be talking to the wall. So thanks a lot for being here. And Mark will see you next week, and I'll see you in 2 weeks.
All right. Take care, everybody. Send your questions and suggestions in our direction.
Good afternoon, folks.
Take care.